Welcome everyone to the 30-minute multifamily money series. I'm excited to continue this series with another fun topic tonight, understanding the real estate market cycle. Stay with me. I promise I'll try to make it fun. Learning can be fun. I'm Dawn Keller. I am a real estate investor and multifamily syndicator. Essentially, what that means is that I help people create passive income through real estate investing. And a syndication, really, what it means, we're just buying multi-million dollar apartment complexes, mostly here in DFW, also in Nashville. And what that does is it gives people like you and me an opportunity to co-own real estate and share in the profit and rental income without being a landlord. So for me personally, I got started investing in real estate because I was looking for a way to put my money to work and to really grow my wealth. My 401k just wasn't cutting it. And I knew there had to be a better way. There had to be something out there. When I was growing up, my parents really just taught me to get a good job and like save your money and put it all in a bank. And so I did all of that and even got myself 401k. And I thought like that's fancy. I'm like doing all the right things. And I think I'm the first one in my family to ever have a 401k. So I thought I was making really good progress. And then somewhere along the line, as we get older, it happens. Um, I realized that it's not going to cut it. My parents now are in their 70s and they're both still working. And I hate that for them. I don't want them to have to work. If they want to, that's great. But I don't want them to have to work. And I don't want to work until I'm 70. I don't know about you guys, but that's not an option for me. And I think that's the reality a lot of people are facing now is we think we're doing all the right things. And then the closer we get to what we think is like retirement age, and we're like, oh my gosh, like, did I save enough? Is it going to be enough? I want to be able to do the things, spend my dreams of traveling and spending time with my family. In the meantime, we're working ourselves to death and sacrificing now and not being able to go to our kids' soccer games or missing out on this. And this is a way to really help get to that financial freedom, really, is buying back your time faster. Multifamily just checked all the boxes for me. I knew there had to be something out there like real estate. I was like, it's got to be the key, but I didn't know what that looked like. And so I started with a single family flip, which probably a lot of people do that, right? It's like an Airbnb or a flip or something. I thought I can do that. And it was really hard. And it was very time consuming. I did make money on it, but I thought, how am I going to scale that and grow that into something bigger? I'd have to do like a lot of flips to grow that and exponentially. And so I knew that wasn't the answer. And fortunately, after doing a lot of research on different asset classes, I came across multifamily and it really just checked all the boxes for me. And now I like sharing that with other people because I find that there's a lot of people that want to invest in real estate because they understand the value of buying a tangible asset, a piece of property that is going to give them cash flow, but also it's going to increase in value over time. But they really just don't know how to get started, or most don't really have the time. We work with a lot of high net worth individuals and CEOs and doctors, and they don't have time to find their own deals, to manage their own deals. And that was kind of me too. At first, I was like, I just want to invest passively. I just want to put my money to work. We're all busy here. But I do like sharing that with other people and just providing education because I didn't even know that this was an option. And I find that there's a lot of people that were in my situation that are looking for the same types of things. So that's really why I like to do these. So that is really all I want to share. Just a little bit background so you guys kind of know who I am and what I'm doing here. But I do have some slides to show you. So let me share my screen here and then we are going to jump in. Okay. So you should be able to see the first slide here now, understanding the real estate market cycle. So here we go. Let's jump in. Okay, so disclaimer first before we get started, I have to put this in here. The information provided is for educational purposes only. Dawn Keller, that's me, is not a CPA, tax advisor, or attorney. The information is not intended as and may not be relied upon as tax, legal, investment, or other advice. Gotta throw that out there. So again, just kind of I'll just cover this really quick, just because I gave you guys a little bit overview on myself, but I am the co-founder. I started a company called Crown Capital Multifamily, and then I partnered up with two other partners. So collectively, we own 3,000 apartment units, 3,000 doors. And personally, I'm invested in 800 doors and have 75 million in assets under management. I could not have done that without the strength of my partners. And we certainly don't do this alone. There is all of these logos that you see here in the center are some of just a few of some of our partners, attorneys and CPAs and advisors that we work with to make this, to pull all this together. Definitely takes a team, but really my passion is teaching others. I love, I guess, like I said earlier, just sharing my knowledge. If it helps someone else, if it helps them to be able to buy back time and create a more meaningful life for them, I am all for it. I think we were all created for something greater. And if I can give back to someone like that and help change the trajectory of their life, that's what I want to do. And I'll cover this really quickly too, since I kind of mentioned a little bit about syndications. Essentially, a syndication is really just a group of people in pooling their money to buy a larger asset, right? So when we buy a $20 million apartment complex, I can't buy that on my own, but collectively, all of us tonight on this webinar, we could pool our money and buy it together. So that's essentially what we're doing. But it allows us to co-own the property and then we all get to share in the profits. Okay, so diving in here on understanding the real estate market cycle. Um, I mean, you guys, we all know that no one can time the market perfectly, and certainly no one can predict the future or what's on the horizon. But there are clues that we can look at, and then we can make an educated guess and informed decisions instead of just randomly throwing darts in the dark and hoping that something sticks. So the problem is that the average investor, they don't really fully understand the importance of a cycle and what that means, or they maybe haven't even been around long enough to have experienced this for themselves. Now, some of us, possibly myself included, have been around long enough to have lived through a few cycles. But if we're not careful, we can still fall victim to the emotional side, the psychology, like where you're making emotionally driven decisions rather than being level headed and being like a true student. And that way you don't succumb to those emotions like greed and fear. However, the superior investor or an informed investor, they pay attention to cycles, right? They understand the importance of cycles, and then they can make judgments about whether they think that we are at the beginning of an upswing or possibly like, are we in the late stages of a bull market? And then they can consider, are we operating in dangerous territory or not? They can also be very aware of how greedy and how fearful the current market is. So then they can adjust their their investing strategy to be more aggressive or defensive, depending on where we think that we are in the cycle. So I know that none of us are average investors on this webinar tonight. So I think otherwise we wouldn't be here to learn. So I think we're already one step ahead, right? Okay, so here's an example of what a cycle might look like. Starting at A, obviously like a low point. So you can see this center line there, the dash line, and that's like the midpoint, right? So starting at A, we're at a low point, and then we go up to B, we're going past that midpoint, you'll notice, all the way up to C, which is the high point, and then back down to D, and you're going towards that midpoint again, but then E, we're past the midpoint, we go way past it. And then F, you're at another low. And then it kind of repeats back up to G reversion, going back up to a midpoint. But what's important here to note is that each peak and low is caused by what happened just before it. They aren't just following each other. They aren't just happening randomly. One event actually causes the next. So for example, like in a bull market, eventually, like so at the top, a peak, like a bull market, eventually the weight becomes so much that it can't sustain anymore. And so it falls out. But you'll notice like in the diagram, it doesn't just fall back to the midpoint, it keeps going past the midpoint to an extreme low, which is typically caused by fear and panic. those average investors that we talked about, those are that succumb to the emotional side of it. That's what we talked about in the last slide. But it's to be expected. Markets have a natural way of self-correcting and moving in those cycles naturally. So it is to be expected. So they can be not necessarily, I mean, they can be somewhat predictable, not always, but we can kind of see, we can understand how that one event can cause the next. And a perfect example of this, actually, that we all have lived through is recent example is in 2020 and 2021, right? So in 2020, the stock market tanked, instilled by fear, right? The fear of COVID-19 and our entire world shutting down. Real estate came to a screeching halt. But then what happened in 2021? Everything skyrocketed. We saw double-digit rent growth. And if you were brave enough to buy anything in 2020 and then sold in 2021, you made a killing. I will admit to you that I was the one buying Starbucks in probably, I think, April-ish of 2020. I mean, Starbucks was down like 60%. And I'm going to buy all day at that price. I know y'all love your Starbucks, and that stock is going to come back. So I'm going to buy at that. I'm going to buy when it's down, when it's low. And then we probably have all heard this famous quote from Mark Twain: history doesn't repeat itself, but it often rhymes. So in order to make an educated assumption on where we are in the cycle, we can first start by looking at history. What has happened leading up to the point where we are right now? And then second, we can look at what are the indications or clues that we're currently seeing in the market. So first, let's look at some history. So it's time for a history lesson, guys. Don't fall asleep on me. I'm going to try to make this interesting, okay? So on this chart, we see a green line, which is, since we're looking at real estate, multifamily real estate, and how this cycle, how this cycle is impacted. The green line is annual rent growth, and then the orange line is vacancy rates. So I put vacancy in there so we can kind of keep an eye on it to see how it's behaving. But mostly for this exercise, we're going to focus on the annual rent growth, the green line. So you can also see on the chart on the left side here, I basically put in just the past 5 years, 2019 to 2023. So you can kind of see what happened there. So let's take a look at what happened. So first, you can first just give you like a little perspective. When we talk about rent growth, annual rent growth, historical average is 2 to 3% annually. And this is national. Definitely, it can be different in your particular market or your sub-market, but just nationally, it's 2 to 3% is just like a normal. So when you look at the chart, let's just take a look at what's happening. So 2019 was pretty normal, 3%. We're looking at that middle column, annual rent growth, 3%, right? Seems normal, right? 2020 down 0.5%. I'm actually kind of surprised that we had any rent growth at all, but people still need a place to live. So, and not surprising, 2020 would have been a great time to buy, but what happened? People were fearful. So not a lot of people did buy. But then look at 2021. Rents skyrocketed. Ridiculous rate, double-digit growth, 13.5%. That's insane. And we know immediately that's not sustainable. That is nowhere near the norm. We know that this cannot sustain. So that's a clue. Maybe this isn't so much of a history lesson as it is detective work, if that makes it sound less boring. Let's go with that. But then guess what happened? So look in 2022. Now rent growth is stabilizing again at 3.2%, right in the normal range. And then for clarification, that doesn't mean that rents are still not high. We're looking at percentage of growth. Okay. So, I mean, most people be like, Dawn, rent is still really high. I get that. But we're looking at percentage of growth when we're talking about the annual rent growth here. So 2021 rent growth was crazy, 13.5% and insane. And then by 2022, it is back down to normal. And then 2023, what happened last year? This is interesting. It's down considerably, 0.8% growth. This is the lowest transaction volume that we've seen since 2014. We've seen really low LTVs, loan to value ratios, tightening lending. But I want you to notice something here. Does anybody see a pattern? Look at, I mean, doesn't 2019 and 2020 look very similar, almost identical to 2022 and 2023? Now, I'm not saying by any means that next year or this year, 2024, that we should be expecting like 13% growth. I'm not by any means at the contrary. I think rent growth right now is very flat, and I think it'll be a very flat year. But this could be another clue about where we are in the market cycle. Okay, so now that your history lesson is over, let's move on to what influences market cycles. Economic factors and psychology. Mostly psychology is the main influencer here, but we're going to look at both. But a real quick example of psychology is the wealth effect, which means, like, when people are feeling like they're feeling wealthy, they feel like times are good and things are booming, they're more likely to spend money, right? So they'll go out to nice dinners, they'll go shopping, probably buy things that they don't need. Um, and the housing market actually plays a lot into this because people tend to keep an eye on the value of their home. So like when you see that green arrow on Zillow, and like the green arrow is pointing up and it's like, oh, your house value just increased. You feel good and you feel like, okay, I feel like I feel wealthy. And you might be like, honey, we're going to Bob's for dinner tonight, which who are my Dallasites on here know that Bob's is the best steakhouse in Dallas. So, but this becomes like a self-fulfilling prophecy because we think that we're feeling good and feeling wealthy. And so we're going to spend more. And this is really based on like, this is what we think the future is going to look like. And then we kind of make that happen by our spending habits. Okay, so let's look at the economy really quick. Since the economy really does have a big impact on real estate, this is like an economic clock. And I'm sorry that this image is really blurry. I borrowed this from one of my mentors, and it was the only image that I could grab. So I apologize that it's kind of blurry, but I'll help you out here. I'll try to read some of the things on here. But essentially, it looks like a clock, right? So you can see 12 o'clock at the top, 12, 1, 2, 3, 4, 5, 6. So 12 being summer, everything is booming, flourishing. Then you've got fall at 3 o'clock, winter at 6 o'clock, everything's cold, everything's dreary. And then you've got spring is great. Things are starting to look better. And then back to summer. So if you think about the economy in a cycle in a clock, ideally you'd want to buy when? At number 6. You'd want to buy when it's 6 o'clock. You'd want to buy when prices are down. It's not as much activity. I mean, that's actually really, and it may seem contrary to what you would think, but that is the best time to buy. And then you would want to sell in summer at 12 o'clock when things are booming. Things are at the top of the market. Best time to sell, right? So I think we are probably around 5 or 6. So now don't go out there just telling everybody, well, Dawn said we're at 6 o'clock. So you saw my disclaimer at the beginning that I am not a CPA, an attorney, and a tax advisor. I do not have a crystal ball. I am not a fortune teller. But there are some clues that we can look at, right? So you can see, so on number 5, and I said so at 5 or 6. So if number 5 says tighter money, if you can't read that, and then number 6 says, or 6 o'clock, 5 o'clock, 6 o'clock, 6 o'clock says falling real estate prices. And then, so let's kind of look at what would you think maybe what if it's 4, what if it's 7? Like, we don't know. It's a range. Again, nobody has a crystal ball, but, so let's look at like number 4 says, falling overseas reserves. Well, we did see some falling overseas reserves in the fall of 2023. And so this has been trending back up. Okay. And then if you look at number 7, it says falling interest rates. Well, we're not there yet. The Fed has made it clear that they are going to maintain rates at least for the foreseeable future. Hopefully, the indication now is maybe mid-year. But for now, it looks like we're facing higher rates for longer. So I don't know that we're quite there yet. Now, again, it's a range. So we don't know. We could be somewhere in there, but that's my best guess. We might be moving towards number 7 or 7 o'clock because we could potentially be looking at those falling interest rates on the horizon. But again, these are just all clues. They're just indicators and clues that we can use. No one has a crystal ball, but you can kind of figure out by looking at these indicators of where we think we might be in the next cycle. So the second thing that influences market cycles is psychology. And really, this is the primary thing that influences some market cycles is psychology. So this chart is another one that I borrowed from one of my mentors, and it shows this emotional roller coaster of the average investor who is making decisions based on emotions. So we talked about that. Oh, I'm sorry, guys. I think I just jumped ahead. Oops, check on you. Okay. So you can see at the top, at the peak of the market there, it says euphoria. So this is like where everything is great and booming. This is the 12 o'clock on the economic clock, right? Everything's great. And you see this little note there says this time it's different, which is dangerous territory. When everyone is like clamoring to like buy, I say caution. So now would be a good time to evaluate the market cycle and the economic factors to see what's really going on. And it says right up there, best to be fearful here. And then on the flip side, at the bottom of the roller coaster there, it says best to be greedy here, right? So we're at the bottom of the cycle. It's best to be greedy here. We're probably all familiar with one of Warren Buffett's most famous sayings or quotes is be fearful when others are greedy and be greedy when others are fearful. And guys, this is not just a cute quote that Warren Buffett just decided to say. He was actually giving us one of the most valuable investing tips that got him to where he is today. This is advice from a multi billionaire, not just a cute saying. This is actually like it help from this is one of his clues, right? That he's helping us with. So let's keep that in mind too. Another way to look at this is a pendulum swing. So some people they can relate to that better. So which is true, right? It's the same kind of thing. You on one side, you've got high prices, optimism, and greed. And then on the other side, you've got low prices, pessimism, and fear on the other. And it just kind of swings back and forth. So again, kind of where are you on that pendulum? Okay, so I told you that the history lesson is over, but now it's time for a pop quiz. um, okay, so there's factors on the left side in blue. And then there are the other two columns. You've got high and low, excessive high, excessive low. And you will kind of like go through these items and see where you think that we are currently. So get your pencils out and go. I'm just kidding. You don't have to do that. But I went ahead and did it, or this is where I think. And you have to pick one or the other. I know sometimes it seems like you're like in between or you're not sure. You have to pick one or the other. So here's what I think. So the economy, let's start with that. So high or low, is it flourishing? Is it sluggish? I know sometimes it doesn't right now, it doesn't feel like it's flourishing, but you got to look at some things like look at GDP, for example. Historical average is 2%. We're at 3.2% as of last quarter. So consumers are still spending like crazy, despite the Fed's attempt to curb spending with higher interest rates. It doesn't seem to be slowing down. So I would say that, I mean, you can't really argue with that. Probably the economy it's still high. It's still flourishing. Outlook, I chose negative. I think there's a lot of uncertainty still in the market. The war in the Middle East, Ukraine, our $35 trillion debt, which I can't even wrap my brain around, an upcoming election. That's a lot of uncertainty. So I'm gonna go with negative here. Interest rates high, and this is all relative, right? I know it's not high compared to the 80s, but okay, we got spoiled with some really low rates, and interest rates are still high. Lending definitely tightened. No question there. Investor sentiment, I chose pessimistic, and I think this one really depends on what side of the coin you're on here. I think most are pessimistic, but hopefully after what we've looked at tonight, I hope that you'll think more objectively, because after all, what did we learn? When others are pessimistic, that's a great time to buy. So I think that it is a great time to buy. And I feel like there is more optimism on the horizon than, let's say, like a year ago. So that could be another clue. Maybe it is sort of pessimistic like right now, but I feel like it's definitely moving towards optimism, definitely more optimistic than it was a year ago. So that could be a clue of which way that pendulum is swinging it again. Markets crowded or ghost town. I chose ghost town. It is in multifamily, especially right now. There is very little trading going on. Not a lot of action. Even in single family, still not a lot of action. Recent performance, I selected strong. Um, I think you can't argue with, like, the stock market's had a great run the last 12 months. I think S&P was like return like a 30% average return or something. So I think you can't, I'm gonna have to give that one a strong performance recently. And then popular opinion, I chose fear. Again, just kind of going with that pessimism still. I think there's a lot of people that are really still sitting on the sidelines that are really unsure. And so I'm going to put that one in fear. But overall, you can see it's not has to be a 100% home run on every high or low, but you can see here the majority of the check boxes are in the low category. So that still kind of, to me, indicates that we're still in that low spot. So now that we've identified where you think that we might be in the cycle, how do you adjust your investment strategy accordingly, right? So you've got aggressive, which is at a low point, versus defensive, which is at a high point. So during a low point, this is where you can be more aggressive. You can risk more capital. You can buy lower quality assets. You can definitely use a lot of financial leverage. And that's, if you're obviously, if you're about to invest, or if you're buying something. But what if you are already in an investment, or you're holding an asset during a low point? You might need to adjust that as well. You might need to hold your asset longer, like in real estate, and ride out that low if you're able to. Now, during a high, you'll want to take more of a defensive strategy. So this is where you might hold more liquidity, buy really high quality assets. And I would definitely be cautious on using financial leverage at a high point. But it doesn't mean that you don't buy at all. There's likely still good deals. There's good deals all the time. For example, like, you could probably take advantage if it's a high point in the market, in the cycle. It's likely that you're going to have lower interest rates. So you could take advantage of having those lower interest rates and lock in a long-term fixed rate. So that's a great strategy there. People don't just like stop buying houses because the market is high. You just have to make adjustments to make it right for your strategy. So, and that's really what all this is about, is awareness and keeping your eye out for those clues, and take the emotion out of it and invest smarter. So that kind of wraps up our cycle, our market cycle, understand the market cycle. But this is really just like why multifamily. I'd love to share with you more about why we invest in multifamily, why I think that that's a really strong asset. I do notice, like, I'm a little bit, I am running. I do like to try to keep these like right at 30 minutes if I can. So I'm gonna skip this for now. I'd love to share this with you if you guys want to schedule a one-on-one call with me, or if you just want some resources. I have free educational resources that I can share with you. But I'm going to skip this for the sake of time for tonight, guys. I'm going to skip this, and then really just conclude with this. If you guys will do me a favor and scan this QR code, and it's going to take you to a form, really a short form that is going to get you into our community of investors. It's an insiders list. And this is where you'll receive other educational events coming up, webinars or resources. You'll be the first to know of upcoming deals that we might have. But a great way to stay connected and really just get plugged in to keep that education going. And I'll leave you with this, guys. I think that we work so hard for our money. You deserve the best for you and your family. And whatever your reason is for being here tonight and wanting to learn more about investing, and maybe it's just, just wanted to check it out. But maybe if you're really interested in trying to figure out how to make your money work for you and achieve that financial freedom, or you're just like me and you don't want to work until you're 70, whatever it is, um, multifamily for me, it really just helped me reach my goals faster. It's helping me reach my goals faster. It helped me really get ahead of the game. And I think just like whatever you do, just promise me one thing. Just do one thing. Promise me that you'll do one thing, like as a step in the direction of your goals and dreams. Life is so short, and I just, if I can help other people just achieve that financial freedom and be able to buy back some of their time so they can spend more time with their families and travel and volunteer or do whatever it is that makes your heart full. That to me is so important in life. And that's really why I want to do this. So, take action, just do one thing. I don't care if it's with me, if you want to set up a call or do something else, just, do your research, but take one step in that direction. Otherwise, all too well that a year from now, you'll wake up and be like, I cannot believe a year went by already. It goes by so fast, right? So just do something, but I'd happy to help. If you want to just scan the QR code, there's a place where you can also just request a one-on-one call with me. If you want to set something up, I'm happy to chat with you one-on-one as well. But that is all for tonight. I hope this was helpful for you guys. I will see you next time. Have a good evening.